Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we turn our attention to one of the more exciting but certainly riskier trading strategies when it comes to the global stock market, and we're talking about investing in IPOs or an IPO investing strategy. Now, most investors tend to buy stocks and hold them for a certain period of time, usually adding it for several months or even years to their portfolio based on their preferences or even their own intuitions and likes and dislikes. But a trading strategy, of course, is much shorter-term focused and looks at capturing very short-term gains within the space of a few days or a few weeks. So let's talk a little bit today about that particular strategy of investing in IPOs. And what's the strategy about? Well, it's fairly simple and based on the same principle or the common principle of buying a stock at a fairly low price and selling it at a higher price for a trading gain. Now, what differs in this strategy is the reasons why we're buying, and it's, of course, to capitalize on the newness and the optimism surrounding a new issue. And so when you exit in the stock, of course, it should be based on a certain period of time as opposed to a target return per se. Now, how successful has this particular trading strategy been in 2019 thus far? Well, let's take a look at some of the headline IPOs and their performances. And we're making an assumption in the IPO trading strategy that investors are buying it on the open and selling it 1 week thereafter from the opening of trading. And we're looking at some of the more popular names. Beyond Meat, the plant-based meat alternative producer, within its first week of trading, was up just around 57%. So if you had exercised this strategy and bought and sold within the period of a week, you would have gotten a return of just around 57%. Fiverr, the online job posting website or platform rather, was up just around 32% within its first week of trading. And social media platform Pinterest was up just around 21% within its first week of its IPO. On the flip side, there are the, flops, and we use the word flops rather unkindly. Uber, ride-sharing platform Uber, within its first week was just up around 2% from its opening trading price, whereas ride-sharing platform Lyft in blue was down just around 18% 1 week after the open of its, or the launch of its IPO. And online pet supplies retailer Chewy was down just around 5% within 1 week of its IPO taking place. Now, on average, how would the strategy have performed in 2019? Well, if you had used the IPO investing strategy, again, buying on the opening of trading and selling within 1 week in a very disciplined way, your return would have been just around 15.1%. How does that compare to a slightly more boring strategy of just buying a S&P 500 index or ETF? Well, the S&P has done quite well year to date thus far, and it's up just around 17.7%. So in fact, the IPO investing strategy in 2019 would have been thus far inferior to the return on the S&P 500. Now, what are some considerations that investors should have when looking at employing the strategy? Well, one, you should stay informed. You need to read up on the stocks that you're investing in. Ultimately, it's a company. They have operations or intended operations, and you need to be fairly up to date on those issues, and the prospectus is an excellent place to start, as well as a quick Google search on some of these companies. Secondly, be disciplined. You're buying, if it's a trading strategy, you need to buy at a particular time and exit as well within your prescribed trading time. And in our example, use a week. It could be sooner, it could be longer, depending on your own preferences, or you could have a particular return target so that once that's reached, even within the time frame, you exit. And that should be a return target either to capitalize and take your gains or to minimize your losses. Thirdly, monitor your position. IPO investing and investing with stocks in general is fairly volatile. Very, very minute news items can move stock prices very widely in terms of price swings, so you always need to monitor your position. There are very many online platforms, websites, and apps that give you real-time pricing for stock prices. And finally, manage your expectations. Even the best of us take an L from time to time, so don't expect to get it right on every occasion. You will have to be able to take a loss at some point in time. So is this strategy right for you? Well, if you are sophisticated, well-informed, and would like to keep well-read, yes. If you are an active portfolio manager or you keep monitoring your positions on almost real time or at least every hour to 2 hours or so for this very volatile strategy, then it's okay. If you have a higher risk tolerance and if you're willing or able to take a loss every now and then this strategy may be one that suits you. That's it for this week's edition. For more information, give us a call at 226-8773. Email us at invest@boursefinancial.com or visit our website at www.bourseinvestment.com. And also, just a reminder, our Sagicor webinar takes place tomorrow, so if you haven't registered as yet, and it's totally free, by the way, please do so. It's going to be certainly interesting discussion. Have yourselves a great investing week. This has been the Bourse Report.